The US dollar had its weakest year in decades. In 2025, the greenback has fallen against all major global currencies, making it the worst performer among 17 peers. The dollar index is down nearly 10% this year, marking its poorest start in almost 50 years. The decline has been driven largely by Federal Reserve interest rate cuts, which reduce the appeal of holding dollar assets. Adding to the pressure were President Donald Trump's tariffs, which unsettled markets earlier this year by raising concerns around growth, inflation, and policy uncertainty. While the dollar has recovered slightly in recent weeks, analysts say the long dollar bull run may now be behind us. A weaker dollar brings clear advantages for parts of the US economy. It makes American goods and services cheaper for foreign buyers, boosting exports and supporting sectors like manufacturing and agriculture. US exports rose by $125 billion in the 9 months through September, up 5% compared to last year. Corporate America is also benefiting. Many large US companies generate a significant share of their revenue overseas, and dollar weakness lifts foreign earnings when converted back into dollars. Equity strategists say that the softer currency has become a meaningful tailwind for corporate profits and stock markets. For everyday Americans, the impact is less positive. A weaker dollar reduces purchasing power, pushing up prices for imported goods and making overseas travel more expensive. These pressures add to inflation risks at a time when consumer prices are still running above the Fed's 2% target. Globally, the dollar's slide reignited the debate on de-dollarization in 2025, while the dollar's share in central bank reserves has fallen to a 20-year low, and some commodities are increasingly priced in other currencies. Analysts say the dollar remains dominant in global trade, finance, and payments. Looking ahead, most forecasts point to further but more gradual dollar weakness in 2026.